Welcome back, everybody. I certainly hope everybody got a brief comfort break. And we continue with our discussions on some of the, policy implications and the policy responses that there have been to the economic shocks brought about by COVID-19. And we've got a fascinating lineup coming up for our discussions now. Let me just briefly, as we start, do some brief introductions of my three guests, Andrew Donaldson, Duresh Ramklas, and Kuben Naidu. And I'll start off with Andrew, who is certainly a seasoned hand, I must say, in much of what we're going to be discussing. He studied at the University of Stellenbosch, UNISA, and at Cambridge, and has taught economics at many universities, and worked for a considerable amount of time at the Department of Finance, and is somebody who has been involved in the work in tax policy, committee of inquiry into the national health insurance system, and was also a member of the team that drafted the 1996 macroeconomic strategy, and also the ITT on social security and retirement reform. No doubt issues that are quite topical over the last while with the green paper that we saw coming out. We also have Duresh Ramklas, who has consulted for the public sector since the late 1990s and is currently working with the Gtac unit at the National Treasury on economic development matters. And we also have Mr. Kuben Naidu, who's the Deputy Governor at the Central Bank, and the CEO of the Prudential Authority and a member of the Monetary Policy Committee. Those are the people who, from time to time, put their heads together and decide on interest rates, and also, give some of their reflections on price and credit conditions in South Africa. He served as the Registrar of Banks and was also named as the first CEO of the PA, the Prudential Authority. So a big welcome to Andrew, Duresh, and to Kuben. And also just a reminder to our participants that we do have a poll, and you can also share some of your questions as the presentations unfold on our Q&A, and we'll certainly take some of those questions as we proceed in our discussions with our three speakers. So I'm going to call up Andrew up first to just give us some brief background and reflections on the role of employment and earnings and the implication that COVID-19 has had, in particular on employment and earnings, and also, the prospects of the recovery. So, Andrew, the platform is yours. Please go ahead.
Hello, thank you, Ayabonga. It's great to be back at the winter school. And those of you who've been attending for the last day and a half have already learnt a great deal about what the economy has been through over the last year, the impact of the pandemic and lockdowns, the global slowdown in the economy on our own economy. Now we start thinking about the future. Those of you who were in the early session today with Gabriel and Rob Davies will have learned a bit about how economists model the performance of the economy, but they were also cautious about policy implications. You can model what happens through multiplier type models in the short term, but in the longer term, of course, development depends on the performance of the economy and policy changes, and that's what we're now going to be talking about in this session and the next one. Economists think about the economy, growth, and the long-term development of an economy in simple ways. They think about it in terms of the broad categories of resources that are mobilized in economic development. And the three broad categories of resources that we're going to try to talk about here in an hour, so we're going to simplify things a great deal, are the labor resources, the employment capacity, the human resources of an economy, finance, capital, the mobilization of finance for investment purposes, and thirdly, institutions. And we're going to particularly talk with some examples about how institutions work and how modernization of institutions will evolve over time. That's the job that Duresh will take on in the third part of this discussion. I'm going to talk more about employment. And I'm going to start off just with a reminder that the president tabled an economic reconstruction and recovery plan in October last year. This is what it looked like. It's got lots of elements to it. I'm not going to go through all of them, but you can see how this is about tackling the very wide range of things that that an economy comprises and that contribute to the performance of an economy. So we're going to now try to think about it in very simple terms, and I'm going to talk about strategy in terms of those three things: employment, and finance, and institutions. So if we look at the long term, this is the next slide now. If we look at the long-term development, well, this is a summary of the plan that the president tabled. You can see some targets there, but just look at the thing at the bottom. As Ayabonga mentioned earlier, we tend in South Africa to have lots of plans, lots of targets, lots of priorities, 8 interventions, 47 key commitments within 12 months in this strategy. Well, how do we really want to think about how to prioritize within that? And here I'm particularly interested in growth and employment, and that's the next slide that'll come up in a moment. That just is a reminder that our economy has not done well for quite a long time. This is a long-term performance, so quite strong growth in the 1940s and 50s and 60s. And there are economists who argue that South Africa suffers from a long-term deterioration in its performance. That's a rather dismal view on where we're headed. In the early 2000s, partly because the commodity prices rose, the economy was doing well, but there was also a sense of encouragement about the performance of the first decade or so of government, the transition to democracy and the changes in policy, the opening up to the rest of the world that brought about stronger economic performance in the early 2000s, and then it lost momentum of the last decade. So are we looking at long-term economic decline, or are we looking at a failed decade after the recession of the last of the post 2009 and the challenges of the Zuma administration and loss of confidence? How do we recover confidence, in a sense, is what this discussion is about. If we look closely at the last decade, and here you've got a graph that has both employment numbers and value added, an indicator of GDP growth in the economy, and it bounces around a bit from year to year, but you can see really unhappy performance after the first few years of recovery from the recession. Look at how that huge knock to the economy in 2009, 2010, and then again at the end of this period. 2020, of course, this is the COVID knock to the economy and a huge decline in economic activity last year, especially impacting quite quickly on employment. But there's a point to these numbers here that perhaps isn't quite as obvious as I'd like it to be, which is that some of the statistics at our disposal, and particularly what we call the quarterly employment statistics, which is a large survey of businesses, what they pay to their employees and how many people they're employing. The quarterly employment survey, quarterly employment statistics tell us that the economy has actually appears to have been growing faster than the national accounts tell us. 2.2% employment growth over a period in which the economy, according to the national accounts, was only growing at about 1.5%. I think that the economy has actually been doing better than the national accounts tell us, both in real earnings growth and in employment growth. That doesn't mean it's doing well. Those are not impressive growth rates. 2% or so in employment is not enough. But nonetheless, the national accounts are not picking up all the structural change that is actually going on in the economy. Some of that structural change you, in a sense, have been talking about in the last session on agriculture, tourism, but also small business activities and personal services, where it's hard to keep track of what's going on. The statisticians don't really know what's going on in township businesses. They certainly don't know what's going on in all rural areas. And so there is some encouragement, I think, in these QES numbers and in other indicators that tell us that there's more to the performance of the economy than we're actually measuring yet in the national accounts. Now, it happens that the national accounts have to be updated from time to time. The updating of our national accounts is overdue. It was supposed to happen in 2019. It was delayed to 2020. It's been delayed again. And this month, SSA tells us they're going to be doing a GDP rebasing. I expect to see upward adjustments in these revisions. We'll wait and see. I hope we get those revisions soon, and we could begin to look at a more realistic picture of our economy than the picture we have at our disposal now, which is formulated in prices and output ratios that are quite outdated. They date back to 2010. Okay, let's move on. So that's just a caution that perhaps there's more going on in the economy than we think. But nonetheless, let's not get away. Let's not pretend that we haven't had a huge knock. And this is the increase in unemployment as measured in the quarterly labor force statistics over the last decade. There's that rather peculiar reduction in the unemployment rate in the second quarter of last year. That's a statistical anomaly because of the way things are measured. But that 32% or so unemployment rate at the end of last year, and the evidence that you've already seen some of, that although the economy has recovered, we've seen a pickup in most sectors of the economy over the last 6 months. Employment has not yet picked up. Employment is clearly lagging behind the recovery in the economy. So the policy challenge is, what do we do to strengthen employment and make our growth more employment intensive? Let's move on, and I'm going to just add a little content to the point I've already made, that there's some structural change in our economy going on anyway, and let's try to understand it. So this is a reconstruction from quarterly labor force statistics, and it's basically a comparison in the blue and the orange brown curves between sectors. And the left-hand graph, earnings, the earnings distribution below the 25th percentile. So if you like, that's the bottom quarter of the earnings distribution. If you were to rank all earnings in the economy, 16 million employed people, then the bottom quarter is in the left-hand graph, and the top quarter is in the graph on the other side. No surprise, agriculture and domestic service household employment dominates the bottom quarter and is, of course, a very small part of earnings in the top quarter of the distribution. Those are low-wage jobs and quite large numbers of households dependent on farm work and household domestic service. But notice how other sectors have begun to expand low-wage unemployment, low-wage employment, business services, and also government services in the last decade. What contributed to that increase that you can see in government services and in business services in low-wage employment over the last decade? Well, in the public sector, this was the growth of public employment programs. This was government beginning to say, our unemployment problem is so severe that we need to put more government resources into employing people on special employment programs and on what we call the community work program, which employs people for just 2 days a week in rural villages under NGOs or municipal management. And what I'm pointing to here is a kind of dilemma in thinking about growth and employment. Yes, it would be nice if we could grow employment in high-wage activities, manufacturing, and the sectors of the economy that employ people at higher earnings and are more productive. That has to be a long-term goal, improved productivity. But when unemployment is very high, we also just need to do the things that bring opportunities to particularly young people looking for their first job that are comparatively straightforward to administer and can grow quite quickly. And that's also what's happening in personal services and households and in township businesses and in the informal sector, where we are beginning to see more activity than there was before. And so growth in the economy that is more inclusive, that creates opportunities for more people, is going to be, for a while, employment that is not particularly high wage, but does open up opportunities and create learning opportunities, especially for young people looking for work. And so growth of local economic development, growth of the township economy, the investments in housing that bring opportunities into and improve living conditions in residential areas, these are all part of a growth strategy that is more inclusive and more employment intensive. Okay, let's move on now to just a reminder here of just how unequal our economy is. It's a terrifying slide, this. So this is, again, a ranking not of employment, but of households. The poorest quintile on the left-hand side, and the richest quintile. A quintile is a fifth of the population on the right-hand side. And two things are shown in this graph. One is, of course, just how unequal incomes are, but also how particularly unequal wage income is. Wage income is the blue part of the graph, and wage income contributes comparatively little to earnings in the bottom half of our earnings distribution. Not only is wage income low, but the proportion of people in households who have jobs is much lower in poorer households. So you've got to do both things. You've got to raise wages over time, but you've also obviously got to look for ways of creating more jobs so that a higher proportion, that's the line in the graph, of people in low-income households have access to work. And I make the point on the left-hand side where there are a few comments about what the policy priority. You can hear that I think that employment growth is the centerpiece of a growth strategy, and so employment-intensive growth is central to what we need to be targeting in developing an economic strategy, and in interrogating what the president's economic strategy says, and in discussing some of the things, as you will do in debates and later this afternoon in the concluding session of the program. But I make a point on the bottom of the left-hand side of this slide that many of the things we need to do to improve living standards don't need new inventions. They need us to do things that the world has known how to do for a century: how to build better houses, how to ensure that there's water and electricity, how to maintain streets and municipal services, how to build public transport systems, how to get modern telecommunications. We have more technologies for doing that at our disposal than we did a century ago, but it's still basically the same thing. It's about telecommunications and the infrastructure that goes with it. Much of what needs to be done to raise living standards is not about doing new fourth generation technology stuff. It's about doing good old-fashioned infrastructure investment and associated with that investment in health and education. We need to get on with that. And I think the point has probably been made several times in the program over the last day or so. We need to stop just talking about that and get on with the job. Now, I want to move on and just introduce the finance issues. This is what Kuben is going to be talking to us a little more. The background to talking about finance and the mobilization of finance for investment purposes is savings and investment. And so we don't employ enough people. We also don't invest enough. And investment, of course, is part of growing productivity in the economy, but also growing employment opportunities. And that's, again, a long-term picture. It goes back to 1946. And you can see both saving and investment have deteriorated since their peak in the 1970s. That period, 1976 to 1981, was a peculiar one. The gold price climbed hugely, and so there was a great boom to the South African economy. But it ran out of steam in the 1980s. And since the 1980s, we've seen this rather poor investment and savings performance. We want to get investment and savings back up to something like 25% of GDP. The really fast-growing economies in the world have savings and investment rates of 40% plus. We probably won't get there, but we could certainly do better than we're doing now. And I'm going to finish up with a couple of slides that talk about the really extraordinary thing that happens in our financial markets last year. So you all know that the government found itself faced with a huge borrowing requirement last year because suddenly revenue crashed as the economy got into difficulties in 2020. And so government's borrowing requirement climbed enormously from a budget deficit of 4 or 5% of GDP to a budget deficit which turned out to be over 10% of GDP. That's the green line at the bottom of the graph. You see that enormous shift at the end after a period of quite a lot of stability in these numbers. Big increase in government's borrowing requirement. How was it financed? Where did the savings come from to finance government's borrowing requirements last year? Well, that's the interesting part of this graph. What you see for the first few years, 2013, 14, 15, 16, 17, is that the government's borrowing requirement, together with the public sector corporations, that's Eskom mainly and Transnet's borrowing requirement, they're deficit institutions, together with a really balanced position of households, which typically have a savings rate of about 0, are financed through our financial institutions. Financial institutions, that's the red curve, take the deposits and savings of households. They go in mainly to our retirement funds. The retirement funds repackage those savings of households and surpluses of businesses and buy government bonds. But actually, it's the foreign sector. That's the blue line at the top on the left-hand side, that has been the largest sector, the largest source of financing of our economy for most of our economic history. Last year, foreign net investment into the South African economy fell to below 0. And it was the surpluses of the business sector that took up the slack. That's the light blue curve that is at the top of the graph on the right-hand side for 2020. An extraordinary change in the financing structure in our economy in 2020. Government runs a big deficit. It's financed by surpluses in our business sector. And that looks like an extraordinary, positive, if you like, story about the financial intermediation that the financial sector is capable of and achieved last year. But the big negative is that those surpluses of businesses in 2020 that were available to finance government's borrowing requirement came from a collapse in business investment. And that takes us on to the last slide or two here, because a collapse in investment can only be a temporary mechanism for financing the needs of government. It's not clearly a strategy for long-term growth. For longer-term growth, that business investment needs to be restored. Business investment needs to be financed. And so that's partly why the Treasury quite rightly emphasizes the need to consolidate the public finances and get the government's borrowing requirement down again. I've used up more than the time than I should have, so I'm just going to finish up with this and hand over to Kuben, who will take us to tell us a bit more about the financial sector and its role in growth and development.
Hi. Good morning, everybody. Good morning, and thanks, Andrew. Andrew's always a very hard act to follow. I'm going to pick up from where he left off. Let me just start off by thanking people for giving me the opportunity to talk on the winter school. It's something very close to my heart. I think I've spoken at all of them. So thanks. I'm going to start off with the short term and then drift to the long term. So I'm going to start off by talking a little bit about the financing challenge during COVID and what happened under COVID. What we know from past experience is that when there's a crisis, you have two things. One is the banks stop lending. Because of economic uncertainty, because of a perception that there's going to be pain in the economy, the banks stop lending. Now, what happens when the banks stop lending is that that's a multiplier effect. Effectively, if I'm a little restaurant and I've got a gas supplier and I've got a rental contract and I've got some staff, my income falls. If I can't get access to credit, I stop paying the gas supplier, I stop paying my rent, I stop paying my staff, and that my spending is their income. And so the first objective of policymakers during a crisis is to try to get credit flowing again and to try to keep the channels of credit and finance going. Now, not only is it natural for people to want to reduce their requirement for borrowing, it is also natural for the banks to stop lending in a crisis. The banks are almost programmed genetically to become risk averse in a crisis. They pull back on lending because they're worried about their balance sheet, they're worried about defaults, they're worried about if I lend to that restaurant, will they ever be able to repay me? What we've seen, especially since the 2008 financial crisis, is that it is absolutely important for policymakers to keep the wheels of credit flowing. In South Africa, there were four main responses to the COVID crisis from an economic point of view. The first was the fiscal. We saw a significant, and Andrew referred to that, significant increase in government spending and government borrowing. The second is monetary. We reduced interest rates to historic lows by about 275 basis points to 3.5%, the lowest on record, I think, in 54 years. We also did something reasonably unusual. We bought government bonds in the bond market, and I'll talk a little bit about that later. But we also injected liquidity. Normally, government runs what's called a money market shortage system, where we create an artificial shortage in the banking system. But this time, we flicked the switch. We had 2 auctions a day to put liquidity into the economy. The money market shortage fell dramatically, and there was an extremely large increase in liquidity in the banking sector. And the fourth thing we did was to provide regulatory relief. So we lowered the capital requirements and the liquidity requirements of banks to try and encourage them to lend. Over and above that, we also tried something that was a bit unusual. So we created the conditions for banks to support their customers, to give them payment holidays, to give them loan restructures. But we also introduced a loan guarantee scheme, which was effectively a risk-sharing partnership between government and the banks. It has not worked as effectively as we would like it to have worked. We were hoping that we would get up to about 70, 80 billion rand of lending. We probably got just below 20 billion of lending. But in concept, it was an attempt to share risk. The bank said, look, we're prepared to lend, but we want to know if things go really wrong, will government back us? Will government bail us out? Now, the political economy of banks being bailed out by government is in South Africa is not an appealing one. I think that's one of the reasons why there's been a fairly high degree of risk aversion in the scheme. But if I take the totality of bank support, loan restructurings, payment holidays, at one time, 11 to 12% of all loans, that's a stock of over 700 billion rands worth of loans, were in some form of debt restructuring around around June, July last year. So in combination, we think we played a positive role in trying to ensure that credit continues to flow. Of course, Andrew mentioned the institutional resilience. One of the institutional elements is the regulatory framework, and banks had good capital buffers and good liquidity buffers, so they were able to continue lending. Would we like them to have lent a bit more? Yes. But in context where all the indicators of a crisis is to have a fall in demand for credit and a fall in supply of credit, we continue to see good credit growth. It's turned in the last 6 months, it's gone negative again, but I think the other factors such as economic uncertainty have played a significant role in that regard, and I'll come back to that. Let me talk a little bit about the market interventions last year, and there were two I mentioned. One is the provision of liquidity to the banking system. That's to try and pump as much money into the system as possible to encourage the banks to lend. But the second that we did on a fairly limited extent, but probably unprecedented in the South African context, was to buy some government bonds. Now, the reason why we bought government bonds was not to try and lower the borrowing requirement for government. There are many people who argue that we should have bought more to try to lower the borrowing requirement for government. Our concern was that there had been what in market speak is a disorderly spike in government's long-term interest rate. So government's long-term borrowing rate went above 11%. As a central bank, we rely on those interest rates to feed through into the economy. And so when we were lowering interest rates to 3.5 at the short end, there was insufficient transmission into the economy. And so we did buy government bonds to try and stabilize the bond market. And again, there are people who argue that we did too little. We would argue that at the end of the day, if we had done too much, and there's a fine line, if we had done too much, the market would have lost confidence in government bonds and government bond issuance, and that would have had an even worse impact on the economy than we had. Let me talk a little bit about the financing issues that Andrew raised in the medium to long term. South Africa is a low savings, low investment economy. That means that in the main, we're reliant on foreigners to finance our investment savings shortfall. That's not an ideal position to be, but that is the reality. The old joke that if you ask somebody, well, how do I get to Dublin? Well, if I'm going to Dublin, I wouldn't start from here. But you are where you are. You are a low savings economy. It would be extremely damaging to investment, but also to development, to household income, if we were to try to force savings up. That would be particularly harsh on both government and on the poor. And so the only way in which you can finance a higher investment requirement is by attracting foreign investment. And a lot of people don't understand that, but if you're reliant on foreign investment, it does mean that your policy outlook has to be focused at attracting foreign investment. That means that your policies have to be sensitive to what foreign investors want or don't want. It's not a nice place to be, but that is the place that I think that South Africa finds itself. So we've got to be able to attract foreign investment, and that is in part one way of breaking that savings investment imbalance, so we can finance a higher rate of investment. The second issue is that while it is absolutely understandable and even desirable for government to run a very large budget deficit in the middle of the COVID crisis, we went into this crisis with a budget deficit of over 6%, and we have to at some point reduce the budget deficit, because at the moment the corporate surpluses are not financing corporate investment, they're financing government. And while it's, again, absolutely important for government to function and to spend during a crisis, we have to gradually but steadily reduce the budget deficit so that there is more resources for the corporates to use for investment. The third ingredient, so being able to attract foreign savings is the first, the ability to reduce the government deficit is the second. The third ingredient is policy certainty. Andrew showed you a graph that corporate investment has been falling steadily since 2010, and that's essentially because of rising mistrust between government and business, rising unease at the policy environment, rising uncertainty, and government's got to fix that. In some areas, they've made some positive steps in energy, perhaps in the partial privatization of SAA, but there are huge areas where there's still a lot of uncertainty. If I talk about mining, there's still uncertainty about property rights. If I talk about the energy, future energy mix, there's still uncertainty. Telecoms, spectrum allocation, there's uncertainty. The tariff regime is uncertain and unpredictable. And so getting policy certainty would be the third ingredient. And the fourth ingredient is a virtuous cycle of rising demand, which would feed rising investment, which would feed rising demand. Now, on that front, I think we're in the fortunate position is that we have fairly supportive commodity prices, fairly high commodity prices, and that is fueling demand in parts of the economy. That is feeding through into the rest of the economy. We have, at the moment, I don't think the commodity boom will last forever, but at the moment, we are in the fortunate position that we've got a very strong trade surplus and a very strong international demand for our exports. If we can use that and channel that demand to get to rising investment, you could create that virtuous cycle where you've got rising investment, rising demand, rising investment, rising demand. So those are the four key ingredients required for long-term investment. The ability to attract foreign investment, the ability to reduce the budget deficit, especially when times are good, the ability to reduce policy uncertainty, and to be able to use the rising demand that we have now to create that virtuous cycle. All of those require stable government, require strong public institutions, require a strong and stable financial sector. And those are the financial institutions that will underpin long-term growth. Let me stop there. Thanks.
Thank you very much, Deputy Governor, for those remarks. And I think certainly just judging by what's coming out of the Q&A, a lot of questions around, I guess, what could or what more could have been done. And we'll certainly come back to those questions in the next few minutes or so. I must say also, Deputy Governor, I like the sweater that you have on there with the team from NASDAQ. Albeit, of course, under difficult conditions, but they need our support nonetheless. Duresh, let me give you an opportunity to give us some of your remarks, and then thereafter we'll take some of the questions that are coming.
No comment on soccer teams. Okay, greetings to all. Can you bring my presentation up? Okay, so I'm going to talk a little bit about institutional modernization as a platform for a more resilient economy, a bit of a mouthful, but I'm really going to focus on the Gtac experience that we've had in supporting the UIF on its TERS rollout. So if you could move on. I thought this was an apt slide. We have focused a lot on the pandemic. And maybe we should focus on mother now. And mother in this term is on the next slide. And it's really about what Andrew and Kuben have been talking about the issues that we have with unemployment. And in a recent Ipsos survey that the World Economic Forum tweeted, interestingly, showed that what countries actually, what people in countries think about. And in South Africa, as you can see, we are thinking about unemployment. It is what concerns us. So if we could move on. This I borrowed from Professor Karim's presentation, and I thought it was very useful because it shows, how the waves have played out. And in fact, government support, in particular UIF TERS, has followed these waves. And as the waves have come on, and as the different lockdown levels have come on, TERS itself had to position itself to be able to pay the affected workers in those lockdown periods. So if we can just move on. Here's a picture of the Minister of Dell, and he's talking about the latest C19 TERS. And that has just recently reopened for the March to June period. And I'm not going to spend too much time, but obviously it has been targeted at the industries that have been, or the sectors that have been most affected. And you heard, about the tourism sector earlier on, and the liquor industry and wine sectors earlier on. And in this one, there's still cinemas and theaters and casinos and museums and all sorts of businesses that cannot open or cannot operate at full capacity during this time. So if we could move on. One complicating factor was the or the unrest that has happened recently. And TERS, which has really been thought through at NEDLAC. And I must make the point about NEDLAC. NEDLAC has been the driving force behind the design and the rollout of the temporary relief scheme. And as the different waves came on, the different conditions had to be met, and this was quite rigorously debated by business and labor and government as to exactly what the terms and conditions of the support will be. And with the public violence that has happened and businesses and employees that have been affected, in fact, labor and business brought it up to say, well, the UIF should actually support this. And after lots of positioning and questioning as to how the UIF could actually support it, the minister has now announced that this will open up a new window to actually support the businesses that were affected, and there will be a maximum amount of 6,700 rands to workers who were affected in this lockdown period. Okay, so we supported, if I could just move on to the next slide as well, please. Okay, so we've had some interesting successes and challenges in the rollout. And I think, obviously one of the big successes has been the fact that the fund has paid out over 62 billion in cash into the economy. And I think it's probably the biggest social relief or relief to workers that has occurred in the economy from government side. The NEDLAC subcommittees that provided the policy direction worked very well. So I was quite impressed by how business and labor and government worked together to organize the TERS to be able to construct something that could give workers support. The operational committee which is a kind of a subcommittee of the NEDLAC working group, provided support to the UIF staff in solving operational challenges, and that is an ongoing mission as well as the subcommittee's work. It's an ongoing mission. And just to give credit to the actual UIF staff who worked under incredibly difficult circumstances, and they were not used to providing turnaround times that were enforced upon them for TERS. They were not used to providing the volume, processing the volume of payments that were required. And they developed the TERS system to be able to pay this out. And there were often instances where there were COVID breakouts in the building in Pretoria. There were all sorts of issues that they had to deal with while working on providing the support. And credit to them that they've actually managed to make that value of payment so far. So, that's on the plus side. There have been successes. On the downside, we had some real challenges. I mean, it was there were some people who took advantage of the situation. They created fake companies. They create faked employees, and many millions were lost in that process. And it came to a point where the department had to set up a forensic audit to be able to go to each of the employers' sites to try and recover some of that money. And if you follow the news about this, you will see that quite a bit of money has been recovered. So that was one issue. And the other issue was around error codes. And I'll show you some of the descriptors on the error codes in the following slides. But we had a lot of errors. So what that actually resulted in is a rejection in the application. So there were hundreds of thousands, and at the moment it's sitting over 1 million rejections where people haven't been paid for various reasons. And we'll go into that just now, but and perhaps one of the big issues that came out, and this was raised by the Auditor General in September or August last year, was the fact that the UIF was not verifying against existing government databases. And so, we couldn't verify against Home Affairs quickly. We couldn't verify against Persal. We couldn't verify against the Department of Social Development's databases. We couldn't verify against the prison databases. And so we had a whole lot of issues that we had to rectify very quickly to be able to process claims to the right people. So if I can just move on. I apologize for the slide, and it's quite a dense slide, but it just shows you the descriptors that we've had on these error codes. And you'll see the first one says deceased employee, inmates not eligible for TERS benefits, salary received during the period is more equal to the normal salary. DPSA employees cannot benefit from TERS. So these are some of the issues. We had government employees also trying to benefit while they were obviously still on a salary, and so they were not allowed to benefit. We had prison inmates who were trying to access the benefits, and they were not supposed to access it. And so there were a whole list of error codes. One of the big error codes was around foreign nationals, and it was very difficult to verify foreign nationals in the country. And it was quite a big issue that carried over for many months because we couldn't adequately identify whether it was a valid foreign worker who needed to benefit. Okay, so those are some of the issues that we had. And I've put up this slide just to show you that what we have here is a combination of trying to do things very quickly, using a fairly new system that had been developed to process payments, but that had to link to the back end, to government back end systems for verification purposes. And government systems, we found, do not talk to each other. They're configured differently. They have, and so they can't easily speak to each other. And so they have what we call interoperability issues. And that has delayed some payments. And what we have to really think about is how to modernize these systems so that we can do these verification checks quickly, and think about how we can have government systems that make payments that can be more client-centric. So how do we focus on the customer rather than and how do we create multiple ways to enter the system and to be able to process them on time to the right person, into the right bank account. Those are things that we really have to think about when we consider how to modernize government systems. So my final slide asks a couple of questions about what is it that we can do now that we've seen what pressure gets put onto payment systems. And it's not only the UIF that has experienced this, the COVID-19 special grant has experienced this issue, and they had to come up with the payment systems. And I know that there's still issues there. We pay public employment programs, and there are many issues there. I've worked on the community work program, and I know there's lots of issues there. So we're paying billions. The government pays billions, and it's multiple departments that have that responsibility. Yet we use different systems to do that payment. And one of the key questions is, can we think about having a single payment system that is fully integrated into other government systems so that we can actually do that verification quickly, do that payment quickly, and have a system that the National Treasury and the Reserve Bank can actually oversee easily. So, some of those initial questions are really about system improvements. And then just as a final policy question, UIF has been used quite effectively. They were in a fortunate position to have lots of money at the start. They had over 140 billion rands, and that's obviously come down by over 60 billion now. But it was used quite effectively to provide support during COVID, and will be used, to help with the public violence. What can we do in the future? How do we use the UIF in the future to play a supporting role to workers? I think that's a crucial policy question that we need to think about. Okay, thank you.
Thank you very much, Duresh, Andrew, and Kuben for those inputs. And as you can see, I think in the question and answer tab, a lot of questions coming through. So we're going to try, I guess, with the time that we have, to maybe segment those. And Andrew, I'm going to start with you because I guess the earlier questions that come through for you on two scores, really. I guess the first one is whether or not the South African corporate sector is doing enough to increase wage growth at the lower percentiles of the income distribution. And also, I guess, the issue around absolute employment. And I think the employment growth question also has some questions around the composition of the type of investment that we have. So let me give that one to you, and then we'll come back to some of the questions for Duresh and Kuben.
Yes, it's a great question, because there's an obvious sense in which if unemployment is 30%, then the business sector is clearly not doing enough for employment creation. But one has to say why, and in some ways it's a kind of chicken and egg situation. We're in a kind of vicious cycle here where unions fight for strong worker protection, they make it so the regulations make it difficult to hire and fire. Labor disputes take a long time to be settled and so on. Businesses therefore become very much more nervous about creating jobs because they think there's not enough flexibility in the system. And the higher unemployment, the higher the level of unemployment, the more unions will fight for more protection, because if you lose your job, you're really in trouble. So you want to make sure that you keep your job. And the more businesses become cautious about creating jobs. So businesses are not responsive enough. Unions, for good reasons, unions are too protective. So how do you break that cycle? Well, you don't easily break it. You've really got to work hard from a policy point of view to change things. I think the central thing that should be done is that we should implement a universal low-wage employment subsidy. We have a youth employment subsidy. You can get a subsidy, a fiscal assistance, a tax benefit if you're employed for 6 months or a year in your first job, only as a young person. But low-wage employment is vulnerable for all low-wage employees. And in other parts of the world, the United States big so-called employment or earned income credit, which is the US equivalent of our youth incentive, is available to all low-wage employees. That, for me, is the single most important thing to do to create an incentive in the business sector to create more jobs and move in a more labor-intensive direction. Not all parts of industry are labor-intensive, but many are, and they are particularly the sectors. Clothing activities, clothing industry has lost 100,000 jobs in the last decade, et cetera, et cetera, et cetera. Those industries need to grow. We need to be a labor-intensive exporter, and the fiscus needs to come to extend the youth employment incentive to be a universal subsidy. The Treasury's just done that, but only for 4 months. But 4 months is not enough to persuade a business to create more jobs. It needs to be permanent.
Kuben, a lot of questions, I guess, posed to you. And I want to maybe pick out, I think you did cover some of the issues around the use of the central bank's balance sheet to restore some semblance of order in the sovereign bond markets. But some of the questions are coming through around the inflation targeting framework and whether or not the SARB should be considering an employment targeting framework. And then I found one quite interesting here, whether or not, I guess, South Africa should be considering the creation of a sovereign wealth fund to benefit for future generations. And I would maybe overlay another question there, what would then be the role of the central bank if indeed that was the course of action pursued?
Sure. I hope people can hear me. There's a bit of background noise. My apologies. In the long run, I think we should have an employment target, right? But in the short run, what do you target? I mean, the bulk of the unemployment is structural, not cyclical. In my time in government, the lowest the unemployment rate has been is 22%. We're at a high point of about 32% now. Which of that is structural and which of that is cyclical? What would be what you would need to define what a neutral rate of unemployment is, right? In order for it to be an effective part of a monetary policy framework. My own view is that once we get to what I would call normal levels of unemployment, once we've cracked the key structural impediments to unemployment, I think we should have a formal employment mandate in the central bank. But it's a really tough thing to do when you've got 32% unemployment, right? I mean, would we have to say, okay, 25% is the neutral unemployment rate? And if unemployment dips below 25, do we tighten monetary policy? I mean, that would the effect of it would be, right? So I think not yet. Yes, but not yet. I do think that we have an implicit employment target. I think the mandate of the central bank is to target price stability in the interest of balanced and sustainable growth. I think that there should be greater onus on the SARB to explain why it moves monetary policy up or down in relation to employment too. So I think greater transparency on the way in which we take account of employment in our own decision-making, in our own reaction function, I think would be positive. But I think it would be premature to formally have an employment target in a country like South Africa, where the bulk of unemployment is structural and not cyclical. Sovereign wealth fund, yes, but at the moment we have public debt of about 4 trillion rand, of which just under 500 billion rand is foreign debt. You can't really have a sovereign wealth fund until you've made a significant dent in that, especially the foreign part of it. It wouldn't make too much sense to have 500 billion rand worth of foreign debt, and then that effectively you're paying 6 or 7% in dollar interest rates on, and then you have a sovereign wealth fund that you buy, dollar assets that yield 1 or 2%. That wouldn't make sense. So yes, I think one day we could, but we don't have the circumstances and the conditions now. We've run a good current account surplus in the last 6 to 12 months, but under normal circumstances, we should and could run a current account deficit. Countries with large sovereign wealth funds are essentially countries with structural current account surpluses, Norway, Saudi Arabia, and so I don't think we are in that boat at the moment. Ayabonga, those were your first two parts of the questions.
Yeah, maybe I've got a cheeky follow-up question, only because you're wearing a Kaiser Chiefs thing. I mean, your sense of where sort of long-run neutral or natural rate of unemployment, where is that for South Africa? I mean, you've said, it was 22% at its best. I mean, where is that? Is that 19, 20, 18, somewhere there?
No, I don't think you could make a sensible call. If you have to take today's circumstances, I would put it somewhere close to 25. Right? But that's politically untenable. Would you really want a neutral rate of unemployment of 25 as part of your monetary policy framework? No. I would say you've got to make more progress in bringing down structural unemployment to single-digit figures before you can really include that. At the height of the boom in 2007-8, we brought the unemployment rate down to 22%. And the other factor in South Africa is the significant skills mismatch. We know that we're a skills short country, so when the economy grows rapidly, you have skilled salaries rising faster, right? And that's also a feature that you have to take into account. So you might well have very high unemployment rate, rapid economic growth, but rising demand for skilled labor that pushes up skilled salaries, that pushes up inflation. It's a particular nuance you'd have to take into account in your framework.
Okay. Kuben, thanks for that response. And I know the organizers are going to kill me, but I can't close this one off without this question for Daresh. Now, Daresh, a question here coming through from Sherilyn Salmon, saying it was relatively easy during the height of the COVID-19 pandemic for social grants payments to be the channel to provide some COVID relief from a grants perspective. But are there plans for very targeted investment in the design of government systems that allow for more effective implementation channels for some of these policy tools?
Yeah. It's a good question. I'm not aware of any specific plans to build out better payment systems. What I do know is that you do have different payment systems that are distributed across government. And I think the point that I made is that payment is a function that exists across multiple departments. And there is an opportunity for government to be able to create a very effective single platform, and maybe that platform could be housed in the Treasury, maybe it could be housed in some other government institution that would have the architecture that would allow for efficient and prompt payments. And I think that's where we need to go. That's where we need to get to, and that, to me, would be a very clever thing for government to do, because it will be able to overall reduce costs and increase efficiencies tremendously. And it at the end of the day, it will have an impact on GDP growth. So I think we do need to get that right. And maybe there is someone who's thinking about it, but I haven't seen that. Thanks.
Sure. Gentlemen, I would have loved to carry on, but we have run out of time, and I want to thank the the three of you, Andrew, Duresh, and Kuben, for joining us. You can see in the question and answer, the questions are coming in thick and fast. Anything from a job guarantee to some of the allocative questions. So certainly that's something we'll have to maybe bank as questions. But I want to thank the three of you for taking time out of your busy schedules to speak to us this morning. So thank you very much, and also encourage our participants to fill out the polls for this session, which has certainly been an engaging and a very interesting one as well. Also, my job ends here, but I guess I get the opportunity to hand over to one of my colleagues, Michael Sachs, and he teaches in the world of economics and public policy and politics as well. He's the leader of the Public Economy Project, and he's also with the Southern Center for Inequality Studies, and is the deputy chair at the Fiscal and Financial Commission. And he'll be picking up in the panel on reflecting on the economic recovery plan and objectives and priorities. We'd spoken about priorities earlier on, and he's got a high-powered panel that's going to be joining him for that. Professor Imran Valodia, Ms. Nomvuyo Kuma, Professor Stephen Friedman, and Mr. Boitumelo Mashilo. So certainly do make sure that you stay on for that one. And from my end, and I guess from my guests in this session and the previous sessions, thank you very much. Also thank you very much for the engaged and very incisive and insightful questions. I think all of us can rest assured that there's a lot of meaningful thought and discussion around some of these issues. So thank you very much. And I'm going to leave you in the capable hands of Professor Michael Sachs.
Thank you.
Cheers.
Cheers.